Good day, ladies and gentlemen, and welcome to a Standard Bank webinar hosted by SBFC, which is Standard Bank Financial Consultancy. My name is Ketwe Kunene, and I am the host for today. Today, we are looking at the economic overview of South Africa, given the latest information regarding government finances, the credit rating, and Eskom. Majority of the presentation will be done by our very own Kevin Lings from Stanlib. But before I give you more information on that, let me just do some housekeeping for those who are new to the process and those who have forgotten your sound. Let's start with that. Make sure your volume is as high as possible. You're going to be with us for about 40 minutes to an hour, so make sure you can hear us clearly. And just so I know that you can hear us clearly, I just need you to indicate for me. There's a panel on the right-hand side of your screen. It's got a small hand that looks like a high five. If you can click that for me, it will indicate that sound is good. And if the majority of the high fives go up, then I can carry on. So I'll just wait for a few high fives to go up. Pumlani Danzi, thank you. Regina Govender, thank you. I see yours. Peter Solomon, thank you. Nolene, I appreciate you. Marianne, Liko, Kabashni, Kwabas Keith. All right, all the high fives are going up. So we are good to go on sound. The last thing that I want to mention is questions. If you do have any questions during this session, you are more than welcome to type them up on the very same panel on the right-hand side of your screen. There's a small questions box. You type that up. We'll see it immediately. But what we'll do is we'll wait till the end of the session to address the questions so that we don't disturb the flow of the presentation. Okay, so let me tell you who's going to take you through the presentation today. We obviously have our resident DJ, Mr. Errol Mayer, who's going to start us off. Just to remind you who Errol Mayer is, because this is our last webinar, so I don't want you to forget him, so that next year when he comes back, you recognize his voice when I start talking about him. Mr. Errol Mayer is a certified financial planner and an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes and Estates and Financial Plans, now prescribed for many universities. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He previously worked as a legal advisor for corporates and as a tax advocate for SARS. And he currently holds a position of advisor and 10 years and he should be possible but not simpler. While at Stanlib, Kevin has managed an asset allocation unit trust fund for 5 years, winning the Micropulse Best in Sector Award. He completed his undergraduate and postgraduate degrees in economics from the University of the Witwatersrand, specializing in public sector finance and international trade. Although the missing piece is Kevin's first book on the South African economy, he has published a number of journal articles, both domestically and internationally. So those are the two gentlemen that you'll be listening to today. I've done my part, so I'm going to take a back seat and allow the gents to take us through the process. Good day, Errol. Good day, Kevin. Thank you for your time. I hand over to you.
Thank you, Katiwe, and good day to everyone. Well, welcome to our final webinar for the year. And what better way than Kevin taking us through the current state of affairs just after the medium-term budget speech. Now, in our next webinar, next year, we will unpack the 2020 National Budget Speech proposals. It will be interesting to see what awaits us. What I do know is that it's unlikely to sit well with many, albeit the wealthy, middle class, or poor. In the medium-term budget speech, the minister does not deal with tax proposals, but it was mentioned that significant tax increases over the past several years leaves only a moderate scope to boost tax revenue. However, it was stated that additional tax measures are under consideration. What that entails, one can only guess. Drastic steps such as a VAT increase and not adjusting the tax tables with inflationary increases have already been implemented. I sincerely hope that we don't see another VAT increase or a failure to adjust tax brackets with inflation, but only time will tell, and we will deal with it when the time comes. Having said that, any suggestion of some form of wealth tax or a once-off levy would perhaps create further negative emotional pushback, since wealth taxes can only be collected from the wealthy. But where does it leave us, the consumer, the foot soldier fighting the financial battle and on the receiving end of financial hardship? I suggest we do our own little medium-term budget. Christmas is around the corner. Don't be silly and overspend the Christmas, because we'll pick up the tab in February and for the remainder of the year. For a while, perhaps save on those luxuries, costly holidays, and presents that is a nice to have instead of a must have. Rather build up some emergency fund to see you through next year for those additional fuel increases, inflationary consumer goods, medical aid costs, etc. Now, if we continuously cannot get our national budget right, namely the basic principle that you cannot spend more money on fruitless expenditure items than what you earn, then we must be so much better disciplined ourselves. And that is why a competent financial planner can assist their clients with those budgeting issues and prioritizing the financial lifestyle needs and expenditure. But the one truth that comes to the fore when things are financially tough: how seriously did you take your own financial planning and personal budgeting? Now, having said that, enjoy the festive season, and over to Kevin.
Thanks, Errol. Afternoon, everyone. So what we're going to do in this session, which is the last for the year, we're going to focus very specifically on South Africa. So I'm not going to talk around some of the big global developments. I think we've discussed that in the past. And I think it's suffice to say that the global economy has slowed to some extent, but we're not overly anxious about that slowdown. We think it's been managed. The focus is really about South Africa and what are we doing to lift our growth rate and try and get it at least to approach 2% within the next 12 to 18 months. And in trying to understand that, we're obviously going to focus on some recent developments. The one is what happened with the medium-term budget. For many people, it was a shock set of announcements. There's a very significant depreciation or deterioration in South Africa's government finances. That has obviously fed into the decision by Moody's to adjust the outlook for South Africa's credit rating from stable to negative. So I need to chat about Moody's and what they're concerned about and whether they will give us a full downgrade next year. And then the third thing is to chat around what is being done at the moment to try and revitalize the economy. And I think you'd be surprised that there are a number of things going on around, say, South African Airways, to some extent Eskom, but other initiatives like the investment summit hosted by the president to try and get investment going in South Africa. And I thought some of the pledges were quite encouraging. So all of that is very much a focus on the South African economic environment. And we'll look forward to what could transpire next year. Obviously, the budget next year is going to be absolutely critical for us in terms of government's ability to follow up on some of these initiatives. The credit rating decision by Moody's that follows the budget, that's going to be critical. Will we get the full downgrade? And then ultimately, can we move the economy into better shape? So to get started, let's talk about where we are in terms of the growth dynamic of the economy. We're pretty much close to the end of the year. We've got a good sense of how the year has unfolded. And at this stage, you're looking at a 0.5% growth in GDP for 2019. If you go back to the start of the year, most people had a forecast that ranged somewhere between 1% and 1.5%. And clearly, as the year has unfolded, we've been systematically disappointed with the progress being made at, I would say, at every level. Our exports have come under pressure, and that's related to the slowdown in global trade. Consumers have found their income becoming more and more constrained. We're just not getting the salary increases we were used to. We're not getting bonus payments, and we're also finding that companies are cutting employment. So consumer income has been under pressure. And then if we look at the investment cycle, particularly government investment or investment into infrastructure, that has declined further. So there have been a number of negatives during the course of the year. The intermittent load shedding obviously hasn't helped, low business confidence. All of these factors have resulted in this 0.5% GDP growth. And if I look over the last 5 years, the growth rate in South Africa has averaged more or less 1% or slightly below that. At this stage for next year, I penciled in growth of 1.1%. The government itself has a growth estimate of around 1.2%. Most people are sitting at around that estimate. And obviously there's a legitimate concern that says, are we not again falling into the same trap where we set a growth rate that we think will be better and then we find ourselves being disappointed? And I think that's a legitimate concern. So as we go through this presentation, I'll try to highlight why is it that we think there will be some improvement in growth. I need to stress, though, that even if we are growing at 1.1% next year, that's hopelessly too little. That type of growth rate will not create the types of employment that the country needs. It's certainly not going to create the tax revenue that the government is desperate to get. It's still going to put us under pressure. So it's critical that South Africa finds a way to systematically lift this growth rate over the next couple of years to get it up above 2% and start to approach 3%. And 3% is critical because that was the average that South Africa was achieving in the run-up to the global financial crisis. So if you said, what was the growth rate South Africa averaged from 1994 through to 2008, it was around 3% or actually a bit higher. And under those circumstances, South Africa would generally move into a better financial space. So I would say in the interim, in the short term, our target is 3% and certainly not 1%. Over the medium term, the target is, can we get the growth rate up closer to 5%? Because then we'll start to make a meaningful difference to unemployment. I don't think that we will achieve 5% within the next 5 years. I think that's more of a 10-year strategy, but I think it's possible to get the growth rate to approach 3% over the next 5 years, and that has to be the immediate focal point. So in the background, obviously we've had government have to consistently revise down, and I thought I would just show you the history of government's forecast with regards to economic growth and what has actually happened. And if you look back all the way to 2013, 2012, you'll see that since that time, government has perpetually assumed that there would be an economic revival and that growth would pick up. And then every single year over the last, let's say 5 to 8 years, we've had to revise those numbers lower. And that constant downward revision to the growth estimate, and you'll see in a while a constant downward revision to tax revenue estimates, has left the government with a credibility problem. Every time you miss your forecasts and you have to revise down, over time people then say, well, your forecasting isn't that credible, and therefore they look at whatever data you're producing and assume that that is equally going to be too optimistic. What the government has done in this medium-term budget, by their own admission, is try to be much more realistic in terms of what's feasible. Of course, by being realistic, the data then looks a lot harsher. It looks a lot more severe, and the deterioration looks more damaging. In the background, please understand that National Treasury is trying to, on purpose, present more realistic data, even if it is harsh data or worse data, in order to try and re-establish their credibility. And I would applaud them for that. Yes, I know the numbers don't look good, but I think there is a purposeful intent to re-establish National Treasury's credibility with budgeting. So in the background, South Africa's unemployment rate, you'll see the data has come out fairly recently. Our unemployment numbers look worse, and we've got to be realistic. These numbers will continue to depreciate until we can get the the growth rate up to around 4 or 5%. We need to create 600,000 jobs a year to stop the unemployment rate rising. Obviously, we're not doing that. If you look at the data over the last year, it tells us that in total we've lost 5,000 jobs. So instead of increasing employment by 600,000, we've actually net lost 5,000 jobs, and as a result the unemployment rate keeps rising, and that will continue on until we can get the growth rate higher. So at this stage we've got 6.5 million people unemployed, and if we create no jobs during the course of next year, that will go to 7 million and systematically keep rising. We've also got the discouraged workers, which people will know well. Those are people who are unemployed but have stopped looking for work, and obviously because they've stopped looking for work, they're no longer counted as unemployed, yet in truth they are actually unemployed. So you could add those back, the 2.5 to 3 million, add them back to the 6.5 million, and South Africa's unemployed sits between 9 and 10 million. That's the job ahead. How do we deal as a society with 9 to 10 million people unemployed, with 600,000 new people entering the labor market every year? It's a massive challenge, and what we do know is that if we can't deal with that, then a whole lot of social consequences evolve, particularly for young people. So if we look at the youth unemployment rate, when you add back discouraged youth, that number has now gone to 70%. And that's just shocking at every level. And clearly society can't sustain itself in the current format if your unemployment rate for young people is 70%. So to me, there has to be a high degree of urgency with regards to getting the growth rate higher. We don't have a huge amount of time to lift South Africa's growth rate at least back to 3%. And we are constantly urging government and government officials to increase the level of urgency with regards to how they deal with Eskom and SAA and other key concerns, because the longer we take to deal with that, the more the unemployment rate will deteriorate. So what did government tell us in the medium-term budget that was so shocking? Well, if you go back 6 months ago, 6 months in the budget at the beginning of this year, the Minister of Finance, Tito, told us that government debt would rise to around about 55% of GDP over the next year, and that it would peak at around 60% of GDP. But after that, government debt would start to come down. And so there was this belief that, yes, there's a deterioration in government finances, but it was under control, and that government had plans to ensure that the debt wouldn't go much above 60% of GDP, and that under these circumstances, we could most probably retain our international credit rating at investment grade from Moody's. That was 6 months ago. So what's happened in the last 6 months? Well, two major things have happened. One is Eskom has needed a lot more money than was envisaged at the beginning of the year. In the beginning of the year, the government said they would allocate 23 billion rand a year to Eskom for the next 10 years. Subsequent to that, we then found out that we had to allocate a lot more money over the next 3 years to Eskom, and government has subsequently made provision to do that. Without allocating that additional money to Eskom, their business would essentially be bankrupt. They wouldn't be able to service their debt. They wouldn't be able to make payments for salaries, and obviously the institution under those circumstances would fail. The president has made it clear that Eskom is too big to fail, and therefore South Africa has no choice but to continue to bail out Eskom. And so we've allocated, instead of just the 23 billion a year, this year we gave them another 26 billion. Next year we're giving them another 33 billion, and the year after that another 10 billion, all of that on top of the 23 billion, and that is simply to keep the business going. That money has to come from government borrowing. The government doesn't have enough tax revenue to give Eskom that type of money. So government is forced to borrow. So that's the first problem that has occurred in the last 6 months that quite frankly wasn't envisaged at the start of this year. The second problem that is clear is that because the economy is so weak, in other words, last year's growth rate was 0.8%, this year's growth rate 0.5%. Because the economy is so weak, tax revenue hasn't kept up with budget. And tax revenue is now it's growing, but it's growing at an ever slower pace. So to illustrate that, in the chart I'm showing you, government set a budget in February. The Minister of Finance said that he thought tax revenue this year would grow at 9%. Currently, tax revenue is growing at 2.7%. Now, that is a massive undercollection relative to what the government envisaged. And it doesn't look likely that tax revenue will suddenly accelerate so that government can make their budget in February next year. So the minister then has to look at this and say, at this stage, we're going to have a tax revenue shortfall. And therefore, he's got to put that into the budget and adjust the numbers. How much is that shortfall? The minister saying 52 billion rand this year that he thought would be there, that is now no longer there. In addition, he told us that next year, he's had to adjust revenue down by just over 80 billion rand. In other words, he thought he would have the money, but it's going to be 80 billion rand less. And in the third year, he's saying that instead of the revenue he thought would be there, he's adjusting it down by 114 billion. So you take those two factors, the tax revenue shortfall, coupled with the extra money for Eskom and other state-owned enterprises like the South African Airways, like the SABC, it means government has had to borrow a lot more and will have to continue to borrow a lot more money. So when you look at government debt, it is now envisaged, instead of being at a peak of 60%, in the next 3 years, it's going to go to 70%. And in the years beyond that, it's envisaged to rise to 80% of GDP. That is massively different to what the minister told us just 6 months ago. And clearly, it tells the credit rating agencies, particularly Moody's, that we've been unable to manage government finances appropriately. And so Moody's has looked at this deterioration and said, we're going to put you on a negative outlook. In other words, unless you come up with something really special in the February budget next year, they're going to revise our credit rating down to below investment grade. Now, I'm going to talk about what Moody's is concerned about in a bit more detail, but I just want to highlight a couple of things on the government finances, and you'll notice, or hopefully notice, that I skipped over a couple of charts. And I just want to go back to those and just highlight a couple of things. The first is the revenue under collection that we're experiencing this year, the 52 billion that the minister said. It's very clear that that revenue under collection is broad-based. Please don't think this is only one area, say corporate taxes or VAT. There are many areas of tax revenue that is underperforming. And what that's telling you is that the economy is weak on a broad basis. It's not just consumers who are struggling. It's companies are under pressure. The government can't collect as much from the fuel levy as they used to. Customs duties or import duties are under pressure. Pretty much all areas of tax revenue are struggling because the economy broadly is incredibly weak. So the answer, therefore, is not necessarily to focus in on how do we get companies more profitable, or it's on the focus has to be on how do we lift the growth rate in South Africa across every area of the economy, because every area is now under pressure. All tax areas are struggling. The other thing I just want to mention with the tax revenue under collection is that that revenue shortfall of 52 billion comes on the back of 5 years of revenue shortfall. In other words, this problem has been building up for a number of years. Yes, it's more noticeable now, but in the background, because the economy hasn't been growing, our tax revenue estimates have constantly had to be revised lower. Unfortunately, while our tax revenue has been revised lower, government was not adjusting their expenditure to a lower amount. Government kept spending at a fairly rapid pace. Now, a lot of that expenditure related to salaries and salary increases, a lot of it obviously related to wasteful expenditure or unauthorized expenditure. It's now extremely clear in the budget that the tax revenue is going to remain problematic, which means that if government wants to get their finances into better shape, they've got to deal with their expenditure more fully. And what that's doing is it's creating a lot of pressure to say, is government able to afford their salary bill? Are they able to afford the number of people they're employing? And the answer is emphatically no. The size of government employment has got way too big. And so a lot of the focus on restructuring government and restructuring SOEs like South African Airways, like Eskom, a lot of that discussion, unfortunately, is going to have to focus on the number of people being employed by these entities. And it's for that reason that you've seen South African Airways highlight that they are looking to retrench close on 1,000 people. Now that is going to hurt the economy, and there's no doubt that that is going to be damaging to a lot of households. But we've got to the point where unless we make these types of hard decisions, these entities, these state-owned enterprises, are not able to survive without significant further government support. And clearly the government and the Minister of Finance are saying we can't continue to do that. It is too damaging for the economy. Therefore, there are big adjustments required. So there will be a focus on tax changes in next year's budget. The Minister of Finance alluded to the fact that perhaps tax rates have to go up. I personally think he'll be cautious in doing that, because by increasing taxes, he probably will do more harm than good. But please anticipate there will be some tax adjustment, even if it is the fiscal drag effect or excise duties on alcohol, cigarettes, etc., fuel levy. He will be forced to make some further tax changes, and they're not going to be to cut taxes to boost households. The government is under significant pressure. They need all the revenue they can get. The big change, though, is going to be, can government adjust their expenditure? And so when we look at the budget next year, that's going to be our focus. Is government able to make significant expenditure changes in the right areas? You don't want government to simply cut expenditure for the sake of it. They've got to be thoughtful on how they restructure the budget. Okay, so let's understand a little bit more about what this situation means for South Africa. And what it means is that there are two areas where we're under pressure. The one is the credit rating, and I'll talk about what Moody's said about us in their review. The second pressure is that we're obviously not able to create jobs. We're not able to undertake investment, and we in particular not able to undertake infrastructure development, even though we need it. If you look at Eskom, if you look at a lot of the state-owned enterprises, they are in survival mode. They're in trying to consolidate their balance sheet. They are not in a position to become expansionary and build new railways or harbors or anything like that. SOEs are under pressure. And so if you look at the fixed investment undertaken by state-owned enterprises, it's been in recession now for pretty much 3 years. And the reason for that is not that South Africa doesn't need infrastructure. It's because those businesses haven't got the financial strength to invest. That is not a sustainable situation for South Africa. South Africa needs investment, infrastructure development over the medium term. we've got to put the SOEs in better shape so that they can start to deliver the appropriate infrastructure. So in simple terms, the SOEs have to find a way to spend less money on things like salaries and spend more money on infrastructure development, and ultimately that would be beneficial for the economy. But we need to recognize that doing that politically is a difficult task given the strength of trade unions, and so the president will have to deal with that fairly cautiously, but ultimately those are the choices we're going to have to make. Okay, so let's turn our attention to Moody's. I put on the chart the history with our Moody's credit rating, and I think it's useful just to remember where we were. Back in 1994, we got our first credit rating from Moody's, and when they first rated South Africa, they gave us what's called an investment grade credit rating. So they, right from the beginning in 94, they thought that South Africa was a good risk. They believed in the country, they believed in the transition that was going to unfold. And over time, as we made progress, Moody's then upped our credit rating to the point that when it came to 2009, 2010, if you look at the chart, South Africa was an A-rated country. That wasn't long ago. We were making progress. We got to an A level, which said that Moody's was regarding us increasingly as a low-risk environment. They were telling foreign investors that South Africa was becoming less risky, and that reflected our improvement. At the time, government debt was 26% of GDP, 26. We're now worried about government debt being 70% of GDP. So that deterioration is very significant. But back in 2009, 2010, South Africa was in very good shape. Clearly, after 2009, after the financial crisis, South Africa started to mismanage the government finances. The growth rate weakened, confidence weakened, corruption started to become more relevant. And as all of those factors started to hurt, Moody's systematically revised down our credit rating, and they've taken it down all the way now to the level that we started at in 1994. So if you think about it, it's 7 years later, and we're back where we started. That is not a good outcome, given that we were A-rated 10 years ago. Moody's, unfortunately, has gone further than that by saying that our credit rating, while it's still investment grade, is now on a negative outlook. So what does the negative outlook mean? The negative outlook means that if there isn't a meaningful improvement in the country within the next 12 to 18 months, they will downgrade us to below investment grade, which means they will take us to a credit rating that is below where we started in 1994. Should that happen, then South Africa will have what's called a junk credit rating by all three of the major international credit rating agencies, which is Fitch, Standard & Poor's, and Moody's. That has very significant implications for South Africa in terms of our ability to attract foreign investment. The reason is that for many foreign investors, they face a legal requirement that says they cannot invest in a country that does not have an investment grade credit rating. At the moment, we have that through Moody's. Yes, the other rating agencies have dropped our credit rating below investment grade, but Moody's has stuck with us. Moody's has persisted even though things were deteriorating, and they've continued to give us an investment grade. Unfortunately, the deterioration in the medium-term budget was so substantial that Moody's could no longer defend the credit rating, and so they put us on a negative outlook. That means if we get downgraded next year to below investment grade, we can expect a significant amount of money to leave South Africa, not because the foreign investor wants to take the money out, it's because they legally will be forced to take the money out. And that potentially can do a lot of damage. How much money? We simply don't know. The estimates range around 100 billion rand would have to leave South Africa. Those estimates could be off by numbers of billions of rand, so we're guessing as to how much money, but it's clear that it would do a lot of damage to the currency and inflict a lot of damage on our financial markets. So we need to be aware of it, and it is a very real possibility. So I thought I would just extract 3 things that Moody's said when they did the review of South Africa. And remember, they're doing this review after the medium-term budget. So what did Moody's specifically say that was quite damaging? The first thing, when they look at the medium-term budget, they concluded that it does not represent what they called a developed, credible fiscal strategy. What do they mean? They mean that while government is being realistic about the data and the deterioration, they don't see in that medium-term budget a clear strategy by government to remedy the problem. And so the message has gone back to the Minister of Finance and to the broader cabinet that they've got to do more to show how they're going to improve the situation. That is creating a lot of pressure, and hopefully we see some developments as a result of that pressure. But it's very clear that right now we do not have a credible strategy. The second thing that Moody's flagged is that even if there is a credible strategy, they said they are not convinced that government will find the political capital to implement the measures that are necessary. What do they mean? They mean that when it comes to, say, South African Airways, it's very clear that there has to be a reduction in the number of people employed in South African Airways. Moody's is asking the question, has the government got enough political capital to make that type of decision in the face of strike activity by the trade unions and in the face of political pushback by people within the ANC government itself? And so there's going to be a very hard test for the president and the cabinet over the coming weeks and over the coming months, is can they demonstrate they've got the political power to make these hard decisions, especially when it comes to the state-owned enterprises? Are they actually willing to start to unbundle Eskom? Are they willing to find a strategic equity partner for South African Airways? Are they willing to do more private-public partnerships? Moody's is not convinced. The third thing that they said, Moody's said, was that in order to maintain the current credit rating, government has to show and quickly develop a credible strategy and demonstrate that in the February budget next year. That is a very short time frame in order to start to get things in better shape. And if we are not able to develop that strategy in time for the February budget, then Moody's will take us to below investment grade. What that means for us is that the February budget, which is ordinarily very important, now becomes absolutely critical. Are we able to show enough progress, political capital, perseverance to demonstrate that we are making progress? Or does Moody's decide that it is too much of a deterioration and that the risks around South Africa have increased? Clearly, there is a significant chance that Moody's decides to downgrade our credit rating. How damaging would that be? I think it would be a knock for South Africa. I think it would be a confidence knock, but I don't think it's an insurmountable negative as long as we are systematically making progress in other areas that over time will lift South Africa's growth rate. And so irrespective of the Moody's outlook on credit rating, South Africa has to start to do the right thing in terms of managing the SOEs, managing their debt, managing government spending, and trying to lift growth. So where does the focus have to be if we're going to lift the growth rate? I don't think the consumer is in a position to do much more to help the economy. Consumers are under strain. Their income has slowed and continued to slow. At the moment, consumer income is growing at around 1% after inflation. That has slowed from a growth rate of around 2.5% 2.5% to 3% 2 years ago. Consumers, as I said earlier, are facing lower salary increases, are facing higher debt levels, are struggling to generate additional income, and therefore one has to be cautious about deciding to take on a significant amount of debt in order to participate in, say, the Black Friday specials that will come up no doubt over the next couple of weeks, or simply indulge, as Errol said, in luxury spending around the Christmas holiday. That would put us under significant pressure that I think we're going to struggle to deal with next year. And I know that message is not uplifting, but unfortunately the household sector is now under strain. There are some people who have nevertheless been indulging in personal loans. And if we look at the growth in personal loans, they're now approaching 13% year on year. And a year ago, they were sitting at a growth rate of 2%, which means that people are feeling the strain. They are under pressure. They are trying to use unsecured credit to continue to spend. It is not necessarily a wise choice because ultimately the debt becomes unaffordable. So I think that consumers are not in a position to significantly raise South Africa's growth rate. They need to guard their balance sheets and make sure that they can withstand additional pressure that may materialize next year in the form of some tax adjustments. So that means that the focus is really on the corporate sector. The corporate sector in South Africa remains in good shape. If you followed any of our previous webinars, we've been highlighting that companies have reasonable cash balances. I've updated that data. It now sits at around 850 billion rand in the hands of corporates that are in banks. That money is mostly idle. The corporate sector obviously over time has lost confidence and they've been unwilling to invest. But we're starting to pick up a change in the rhetoric around this and the change in attitude from some of the corporates. I think the President's Investment Summit last week was a critical event. Clearly, there were a number of corporates that are willing to stand up and be counted and to pledge additional investment money over the next couple of years. And so the President was able to announce around 360 billion in additional investment from the private sector. When you drill down into that investment, some of it obviously was investment that would have happened anyway. So government's really taking the credit for it, which is probably not right, but hey, any spending is good. But there were additional projects announced by the corporate sector, which are expansionary nature, which are new, and hopefully are built upon by other corporates. It's also clear to me that there were a number of foreign countries represented at the investment summit. I had the opportunity to attend the summit in Sandton. And what I noticed was a huge delegation from France, a delegation from China, the United States, and all of them seemed quite enthusiastic in trying to find a way to assist South Africa. In other words, I don't think we're alone. I don't think we're isolated. The President has built up enormous respect internationally. Many people have a huge amount of faith in him that he is able to effect the turnaround. And I think he's drawing on that to get foreigners interested in investing in this country. So I took it as a positive last week. I also think the announcements around the restructuring of Eskom, yes, it's taking time, but I regard that as a positive. I think that the announcements around looking for a strategic equity partner in South African Airways, I think is a positive story. The restructuring of SAA, I think, is a positive story. And when I look at it, there are a number of things that are starting to change. We're actively trying to make it easier to do business. I would urge you to look at the new website on registering business. It looks impressive. I think we're going to find ourselves moving up in the global ranking on the ease of doing business. We've started to add many more countries on the visa program so that people can visit us much more easily. I think you're going to see further announcements to boost the tourism sector. So in my mind, systematically, there are things that are changing that will start to play out more fully next year that help us to get the growth rate up. And if you remember at the start of the presentation, I was saying a growth rate of around 1%. And I think there's enough there. Clearly, the 1%, as I mentioned previously, is not enough. But I think we are moving in the right direction. And I'm gaining confidence that our numbers will be better next year than where we are now. It doesn't mean it's an easy road, it's a long road. But I do think that we'll make progress. So the last thing I want to just leave you with is, what is it that you need to watch in order to show that this progress is being made? Not just watch what the Eskom story is or the SAA or what the president says, but a tangible thing to watch is, please, the South African Business Confidence Index. The number at the moment is at a 20-year low. That is shocking. It gets surveyed once a quarter, and if you want to understand whether South African is making real progress, have a look at what business is saying in that confidence index and whether we can start to get this number to move higher. That will tell you whether business is believing in the reforms that the president is trying to introduce and in some of these initiatives to change the outlook for the state-owned enterprises. So I think a couple of positives on the horizon. Obviously, the current environment remains tough. The unemployment rate is shockingly weak. All of those things are well known. But I do think next year we're going to get better news than what we have right now. That's more or less all I'm going to ramble on about. I think we've got some time for some questions. So I, with the help of our experts, find the questions.
Thank you, Kevin. Thank you, Errol. While we look for the questions, just a reminder that the session is recorded and will be posted on our YouTube channel soon. You'll get a thank you note with the link for that. And let's see.
Okay, we've got a question from Leslie. Hello, I'm now living in the UK. Why are you in the UK, Leslie? I've been trying to go online with a StanLib account. Oh, that sounds like a technical. I was given the temporary. Okay, Leslie, I think if you try and contact me offline, we can help you with any of the sort of admin issues that you may have with getting online with StanLib. I must say that I think, I mean, I work for StanLib, but I must say we've made huge progress in our online presence and in our platform to engage with investors. So I urge you to check that out. I'm looking for additional questions. We got a question from Robert. Moody's is not concerned and neither are many taxpayers. The result is that many are leaving South Africa, black and white. Have you factored this into your level of confidence? So there is a discussion going on with regards to immigration from South Africa. And I had an opportunity to talk to National Treasury immediately after the medium-term budget. And what they flagged was that the number of taxpayers in the high income brackets is now falling. And they are looking into that, but the suspicion is that that partly relates to immigration. And clearly, it is having a factor in terms of tax collection in South Africa. And it's something that I think government is becoming more aware of. Obviously, there aren't specific measures in place to necessarily do something directly about that. And so we have factored it into our forecasts. We put it into our tax revenue estimates. And it's clearly part of the reason why government had to revise down their revenue estimates so substantially. We can't, as a country, afford to lose people to the UK or any other place simply because skills are in short supply. So hopefully the environment improves where we're not in that position. I've got a question here about what was the incremental amount raised by the increase of VAT to 15%? It's a good question. The VAT increase did raise additional money, but what you realize relative to budget, it is significantly behind budget. In other words, increasing VAT did not in the end generate the benefits that was envisaged. And the reason appears to be that the economy lost more momentum than was thought, and therefore retail sales were less, and so VAT collection was less. The increase of the VAT itself would have contributed to that. In other words, you're starting to make an argument that increasing taxes becomes counterproductive. And you can get to the point where you raise taxes and you end up simply collecting less money because the tax increase itself causes the economy to weaken further. That message has been spelled out very clearly now to government, and I think hopefully the Minister of Finance takes that into account in the February budget next year. There's a question, maybe Errol can help, from Lloyd. Hi, I understand that South Africa will soon start taxing those people working in the Middle East. How will that continue? How will that continue to the growth of, or I assume contribute to the growth of the country? I'm not up on the tax with regards to the Middle East and how that would work. But clearly, obviously, any tax revenue we can generate in South Africa can be beneficial for this country if we spend the money wisely. We keep making the point that the situation government is in terms of their debt, etc., is not the problem itself. The problem is, what did government spend the money on? When they took on all this additional debt, where did the money go? And clearly it didn't go on infrastructure and on revitalizing water and energy. It went mostly on salaries and wasteful expenditure. So it's what we spent the money on that is problematic. We've got a question from Nolene. Do you know what the progress of getting funds back from Zuma, Gupta's, etc.? Surely we can recover much tax from these areas. It's more than likely that that money is gone, as in gone. There, over time, there will be efforts, I suspect, made to try and recoup where possible. But my understanding of this from international experience has been that once you have this level of corruption, it's very difficult to claw back that. The assets quickly disappear, the cash disappears, and it's a long, laborious process to try and uncover it. And in the end, I would argue that if we collect 10% of the money that has been corrupted, we would have done well. So I don't think we can bank on necessarily a huge amount of money flowing back to South Africa. We've got a question, another question. What is the impact of the US-China trade conflict on our South Africa? It is a negative impact. That there has been a marked slowdown in global trade as a result of the US-China trade discussions, and South Africa's been caught up in that. And we've seen our exports come under pressure as a direct result. And it's hurt our economy and hurt our prospects of getting an economic revival. So no doubt it's been a factor. And if South Africa wants to lift the growth rate more meaningfully, then we are more able to do that if the world is in better shape. So right now we're not getting any benefit from the world economy. In fact, it's a net negative. So we've kind of got to find a way to do it ourselves. And I think we can get the growth rate better by looking at our own circumstances, and then hopefully at some point we get an uplift from the global environment. But at the moment, yes, it's a net negative in terms of export performance. Can South Africa benefit from the impact of Brexit? There is an opportunity. Obviously, the UK at some point will exit, and then they'll be looking to re-establish trade partners with other countries. And South Africa has a long trading history with the UK. We trade quite a lot with them, and there's no doubt we could secure better trade deals with the UK and see if we can't benefit. I would just make the point, though, that we have good trade deals with a number of countries. We just don't use it. If I look at a lot of industry in South Africa, particularly manufacturing, I think we could do a better job in trying to export and find markets. We tend to be too insular. There are good trade deals if we just try to use them more effectively. What is your view? Got a question from, what is your view on government's plan to break Eskom into three? I think it's a good thing. I think it will allow for some identification of where Eskom is doing a decent job and where there are problems, and also try and identify areas of Eskom that you could attract outside investment into. The primary reason for breaking Eskom up into 3 entities is really to manage the bad part better and to benefit from the good parts. The good parts seem to be more on the transmission side of Eskom, so it's entirely feasible that if you had a division or an entity that was just focused on transmission, that you could entice foreigners to invest in that and maybe get an uplift. And the areas that are struggling relate to generation of power, and maybe then you need to look more thoughtfully at whether you need all those power stations and whether you can't get more private sector power. So I think it will allow for better decision making down the line. At the moment, the entity is very complex and it's difficult to see exactly where the problems lie. So I think breaking up Eskom would be a good move ultimately as a way of trying to get private sector more involved. I'm just looking for additional questions. I've got a question, Ludwig, saying, can we get an increase in VAT? We could. I hope not. I somehow think the minister will avoid that. I think there'll be a realization that increasing VAT further would probably be a negative effect, and probably also result in significant pushback from the population, because most consumers and households are already under significant pressure. I think he'll avoid it, so I'm not anticipating an increase in VAT next year. I've got a question from Mark. In your view, how will the NHI have an effect on government spending and confidence, especially after the medium-term budget? It became clear after the medium-term budget that South Africa can't afford the NHI. The estimates have gone up dramatically as to how much this would cost. The deterioration in government finance is so substantial that for the moment it's unlikely that government can actively pursue this as an initiative. It will be have money or through additional borrowing, and we don't have either available. So I think you're going to see the NHI take a backseat for the moment. Obviously, if the economy gets into better shape and tax revenues improving and employment's improving, then it's something I think the government will revisit more fully. But for the moment, it's very difficult for them to push ahead with it. National Treasury will simply tell government that there's no money to fund an ambitious NHI program. So it's many years away at this stage. Okay, I think I've gone through most of the questions. We're almost out of time, so I hope that made some sense. Thank you very much.
Thank you, Kevin. Thank you, Errol. And if you'd like a financial advisor to get in touch with you, all you need to do is SMS the word guide to the number 31791. The number is 31791, and you just need to put in the word guide. Or you can send an email to SBFC Voice and Digital at standardbank.co.za. That's SBFC Voice and Digital at standardbank.co.za. As I said before, the session is recorded. It will be on our YouTube channel with all the previous webinars. And this is the last webinar for the year. So we hope you have a good festive season. Spend responsibly as you've been advised. And we will see you next year. Have a good Christmas, a good New Year. Thank you very much and goodbye.